Stocks are flirting with record highs, and investors seem to be worried about short-term volatility. At least that's what a new survey from Bankrate found. Just 17% of respondents view stocks as a good long-term investment. So where should investors park their money? Let's bring in Brian Levitt, senior investment strategist at OppenheimerFunds for more. All right, Brian, what do you think? I mean, if investors are afraid of stocks amid volatility, I mean, where should they be putting their money?
I actually find that study actually makes me more optimistic about equities and where investors should be positioning their money. I mean, typically, market cycles end with a significant amount of complacency. Everybody's fully invested. Nobody sees the next worrisome sign coming down the road that ultimately is going to end the cycle and then, create a market correction. And I still think we're a long way away from that. I think global equities are positioned far better than any other asset class for investors with a growth objective. I mean, usually when these market cycles end, what you typically have is you're near the end of a Fed's tightening cycle.
Right.
You see a flattening or an inversion of the yield curve, a lot of complacency amongst investors, high valuations, and I don't think we're there on any of those metrics.
Right, but are there certain sectors within the market that might be less risky so people can sleep a little bit better at night, but still get those strong returns?
Well, investors need to think about what their objective is. I mean, obviously, if they're looking for income, preservation of capital, they're going to want to still have ballast in their portfolio, so you're still going to want to own high-quality bonds, things that could protect yourself in a downturn. But I would marry that or barbell that, particularly for those with an income objective, you're going to have to look more to credit or equity-like assets. Within the equity markets, what we have now is, I think it becomes far more of a global stock picker's market. I don't think there's a sector that necessarily protects you. The old bond proxies, utilities, telecoms, they're going to be hurt should interest rates trend higher. What I think now is as you start to see intra-stock correlations come down and active managers start to outperform as they have year to date, what you're going to want to look for is managers within a mandate that you select or with an objective that you have, look for the best companies that can generate true earnings growth in a world where you're not going to see big macro growth. So what are the trends that are going to drive long-term opportunity for investors?
Yeah, and maybe dividend stocks as well?
So within dividend stocks, you're going to want to you want to be clear that you're not necessarily just reaching for the highest dividend payers, because the highest dividend payers, like you've seen in REITs or you've seen in utilities, are going to trade as bonds have traded. So interest rates go up, they're going to sell off. Interest rates go down, they're going to rally. So it's in essence a bond proxy. What I would say is dividends, of course, are a large component historically of return, do provide cushions during bouts of volatility. But you want to look more towards companies that are not only paying a dividend but are growing the dividend. Those are companies that are still less valued or more fairly valued to the market than the highest dividend payers.
All right, and there's also talk about a correction, of course, as stocks flirt with record highs. Is that something you're worried about? And do you think some of these sky-high valuations we're seeing is driving that anxiety among investors?
So there's a correction every year in markets. So if you look from 1980 to today, there's been a greater than 5% correction every year but one. The one that we didn't have, it was 1995, where you had a 3% correction. So there's always going to be corrections in markets. We have not had a big one, primarily because of policy. So could you have one? Sure. Will it amount to anything? In my opinion, no. You want to get the big term calls right. The big term calls right are easy monetary policy, valuations reasonable given the interest rate and inflation environment, very little complacency amongst investors, and in my opinion, we're still very early on in the credit cycle.
All right, and just real quick, what about exchange-traded funds? Those have lower fees and some are pretty diversified. Do you think that's a better fit for some of the anxious investors out there?
So the exchange-traded funds have done well in the rising tide environment. They've underperformed year to date. Primarily, they've underperformed year to date because investors have become more selective. I would say that investors would want to look more to active managers. Active managers have really done well during bouts of volatility compared to passive. You can look at 08, 09. You can look at 2001, 2002. Active managers beat passive strategies pretty significantly over those time periods.
All right, Brian Levitt, senior investment strategist at OppenheimerFunds. Thanks very much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.